Hello, everyone. Thank you for joining us today. As we're coming in the webinar room, I want to welcome you. My name is Marcia Butler. I'm the webinar director here at Advice Chaser, and we're so glad to have you here today. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Just a couple of housekeeping notes. Attendees are muted, but we do encourage you to ask questions using the chat box, and I will be our moderator today, and we'll make sure those get handled. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well, and we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. And let me go ahead and get your picture up here, Tim. Tim Dorman is a fee-only certified financial planner in Morton, Illinois, and his goal is to ensure clients are prepared for retirement. Tim's career in financial services began as an intern at a commodity brokerage firm in Bloomington, Illinois. He completed his internship there and graduated magna cum laude with a Bachelor of Science degree from Illinois State University. He then became a licensed financial advisor in 2002. Before founding his own wealth management firm, Tim was also the founder, owner, and president of Tim's Ace Hardware Interiors Brokers in Peoria, Illinois. Tim has spent time as a real estate broker in Lake Ozark, Missouri, and has previously served as a member of the Illinois Air National Guard. And Tim, I'm going to go ahead and turn the time over to you, and excited to get this started.
All right, thank you. Hello, everyone, and welcome. My goal with workshops like these is to always to inform and educate. And I love doing educational workshops because typically the people that attend are doers, right? Not drifters or procrastinators. And of course, that's what, it's always better for us to engage with people that actually want to take action. And so since a very young age, I've always been interested in how to make money work for me, right? Which of course led to investing, and then led to me wanting to help other people help them make their money work for them to achieve their goals. And because you're not here to hear about me, but that is essentially what's led us all here today. Okay, so we've all become very accustomed now to the negative, scary headlines, right? But rather than go into all the negative headlines that the media is pumping out 24/7, what I really want to do is to encourage you to be very careful and mindful, because one of the biggest mistakes that we see people make is indecision at this point in their lives, and that can be a big problem. As I mentioned, right, don't be a drifter, don't be a procrastinator, and then also people have used their intuition or maybe a 401k or whatever to build up to this point in their life, and they just stick with what they're doing, and they don't even realize all the ways that the tax code is set up to siphon your money away from you in retirement. And that's, of course, what we're going to cover today. But sometimes people come to us and then, they don't do something, they don't take action. And then they have fewer options down the line because they did not put together or implement a plan when it could have really helped them move the needle. Okay, so here's the problem, right? Simply put, people often pay more in taxes because of our confusing tax code that treats different income types differently in retirement, and there's a lot of hidden taxes and penalties. So the theme of today is it is not about your tax rate in retirement is not going to be most affected by your actual income, but where your income comes from. So remember that. Often poor choice or misunderstanding of our tax code can lead to people paying more in taxes than necessary over their retirement, often quite a bit more, as we often find people end up paying tens of thousands, if not hundreds of thousands, and sometimes into the millions more in taxes over the course of a 20, 30, 40-year retirement because of the way our system is set up. And people don't even realize they're doing it, but that leads to them having less and be able to leave less of a legacy, right? And we don't want that to be you, and you don't want that to be you either. And of course, that's why you're here. Okay, a few more things to consider is that, next slide. A few more things to consider is that you guys get one retirement, right? Just one and done. And what often we find that do-it-yourselfers or maybe people that have been working with an advisor that's more of an accumulation type advisor, everybody's primarily always working on investment strategy, right? Which of course is important, but it's not going to keep you from getting hosed in taxes. So while you guys get one retirement, we help people retire every single day. So we know what to look for, and forgive the pun, but people often don't know what they don't know. And we see that every day. Okay, so here's what we're going to do over the next 40 minutes or so. As I'm going to start by showing you how our tax code can cause more of your Social Security to be taxed than might be necessary, and how Medicare can have its own surcharges and tax traps. And then I'm going to cover some tax concerns that you're going to run into when you start taking money from your various account types, like your 401ks, your IRAs, your Roths, and your after-tax accounts, different types of accounts, and maybe a few possible solutions to how to think about those different types of accounts to help mitigate your lifetime tax liability. And this is going to include, to defer or not to defer your taxes. And this is going to be tied to tools like Roth conversions and how they work. Then I'm going to discuss the widows or widowers tax, another awareness type thing. And then I'm going to briefly hit on qualified charitable distributions, a great tax tool for those charitably inclined. And then I'm going to wrap up with the sequence of return risk, because I'm guessing, many of you, if not all of us right now, are worried about our investments because of the volatility. So we're going to discuss that risk. And then I'm going to introduce our prescription for that sequence of return risk, which is our guardrail withdrawal strategy, because you have to have a plan. And I do want to note that everyone's tax situation is different, right? So you always need to consult a qualified professional tax advisor to discuss your specific situation. We do a lot of tax planning at my firm, but we don't do tax preparation yet. We leave that to the CPAs. And basically the difference is, tax preparers are going to look at your situation every single year, and they're going to try to keep you as low as possible that particular year, while our job is to look out over the next 10, 20, 30 years and smooth out and lower and limit your lifetime tax liability. A lot of times they don't do that because it's more of a transaction. They're just every day, they're just in tax time, they're just, pumping out return after return after return. And they're all super busy if you've ever run into that. All right. So we're going to start with Social Security and how the provisional income formula works, and then the thresholds that go with it. And it can be pretty confusing. But I always like to start with, a lot of times people don't realize once you get to retirement, and unfortunately half the country right now just has Social Security for their retirement, right? So if all you have in your Social Security on your tax return is Social Security, then you're not going to pay any federal income tax at all. So that part's good, right? And a lot of times it's common for most advisors to just tell people that do have assets or other types of income just to say, hey, 85% of your benefit is going to be taxed. You're going to get 15% for free. And a lot of time for maybe high income people or people that have to take a lot out of their pre-tax accounts, or maybe have a pension, which of course a lot of those are going away, but they're still out there. But for middle income and upper middle income folks, that's not always true. It's based on the provisional income formula, which can, like I said, have some strange impacts. And we're going to walk through an example. But as you can see up on the screen now, the provisional income formula basically is 50% of Social Security. I think we need to go keep going. Just go all the way through all those, put them all up there. Yeah, put the whole formula up. There you go. So basically what it is though, is it's 50% of Social Security, and then they add in any other type of income you have, even non-taxable interest like municipal bonds if you have those. So they throw everything in there. So that's nice of them, right? Okay, so let's take a look at the next slide and see the thresholds. So the thresholds, there's a 50% threshold, and then there's an 85%. And as you can see here, these are single and then married filing jointly. So there's different thresholds that we have to apply after we add up the provisional income. So on the next slide, we're going to take a look at a couple examples. All right, so there's two examples here, and they're both looking for $60,000 in total income. And on the top example here, we've got $20,000 of Social Security income, and we got $40,000 coming from an IRA withdrawal, and that's what people are using to live on in this scenario. And we're going to take half of the Social Security, right? And then we're going to add that to the IRA withdrawal, and that's going to give us $50,000 of provisional income. And if we apply the thresholds to that, it's going to cause 55% of the Social Security benefit to be taxed. We got to apply it for married filing jointly. We're going to apply the first threshold and then the second threshold. And that's going to cause $11,100 to be taxed of their Social Security. And then the next example, we still have the $60,000 of household income, but in this one we have $40,000 coming from Social Security, so a larger Social Security, and then we only have $20,000 coming from the IRA withdrawal. So we're going to take half Social Security, and then so that's $20,000, right, plus the $20,000, and we're going to get up to $40,000 this time. So we're going to stay over the 85% threshold of $44,000, but we're still going to hit that $32,000. So in this scenario, it's going to cause only 10% of their Social Security to be taxed, which is going to be about $4,000. So just that alone shows you how, taking different income from different places can cause different amounts to be taxed. And so it's definitely, when you get to retirement age, you want to coordinate your Social Security benefit with other sources of income that you're going to have, because there's certain things and certain options you can do that can limit, or that are going to limit your lifetime tax liability. So remember, it's not about the income that you live on in retirement that's going to determine your tax bill. It's about where that income comes from, as you can see here, right? Today's theme. And everybody obviously always has a conversation with how much money they're going to need to live on in retirement. That's obvious. But where that income comes from, you want to lay the tax code on top of all your income and see how it's going to affect everything, because you want to minimize how much impact the IRS is going to have on your life, right? So it's really important conversation to have. And if you haven't been having it, you need to. Okay. And now we're going to talk about the Medicare thresholds, and then, how you could end up paying more in Medicare Part B and D premiums. So, here everybody gets to age 65, and I'm sure everybody is aware of this, that you're going to, you get your Medicare Part A for free, right? You've been paying into it your whole life, but now you get to this age and you're going to have to start paying for Parts B and D, and Medicare premiums are income adjusted. So in other words, they're going to be affected by your modified adjusted gross income. And if it gets too high, it's going to cause your Medicare premiums to go up. And, a lot of times people, when I first meet with them, they look at the screen or they look at the thresholds and they say, you know what, Tim, we're married, the premiums don't go up until, $182,000 of income. So, a lot of times they're thinking, Tim, we're never going to hit that $182,000. So we don't have to worry about this. It's not a concern of ours. So I hear that all the time. But in fact, I had a couple of years ago, I had a lady attend a workshop that I did. And of course, she ended up eventually partnering with my firm now, but we helped her out and we did some tax mapping and some tax planning for her. And, she realized pretty quick is that through the early years of her retirement, she wasn't even close to hitting those thresholds, right? For the Medicare premiums to be increased, or it's known as IRMA, or income related monthly adjustment amount. She wasn't even close. But when she hit RMD age, and of course, she had done what most people do in their 60s, she didn't spend or move any of her IRA money because, of course, her existing advisor told her not to. She said, well, if you don't need it, don't spend it. But then the RMDs that she had to start taking out put her into these higher brackets. In fact, she got kicked up into the third tier. And as you can see here on the screen, she ended up paying thousands more in Medicare alone, just because she wasn't doing proper tax planning ahead of time in her 60s when she could really move the needle. So as you can see, all this stuff together really starts to add up. Okay, another big factor that people always, I always hate to be the bearer of bad news, but every time I meet with people, I'm like, you also have to think, what's your after-tax saving picture look like, before you retire? Most people always forget that Uncle Sam has, they have a stake in your pre-tax accounts, and they're going to get their pound of flesh, right? So if you take a look here at this screen, if you've got $500,000 in your 401k, or an IRA, it's not really $500,000 for you to do with as you please, right? As you can see there, if you get taxed at 35%, it's going to be $325, or 37%, it's going to be $315. That's actually yours. So I think you get the idea. So remember, it's not about where your income, retirement, or it's not about your income and retirement that's going to affect the amount of taxes that you pay. It's about where that income comes from, and we have two big problems, right? The vast majority of people on this webinar and retirees in general have a large chunk of assets in tax deferred accounts, usually around 80%, just statistically. So how do you get that money out of that in the most tax efficient way possible out of those accounts? And then number two, how do you put together an income stream in retirement to minimize your lifetime tax liability? Okay, so now we're going to discuss a few concepts and case studies. The first three types of money, and then to defer or not to defer. And then we're going to discuss what the widow's or widower's tax is. All right. So we're going to start with the three types of money. So what does all this mean? Well, to illustrate, what we're going to do is we're going to buy a hypothetical stock called ABC. Now, of course, the reason that we're buying it is because we believe that ABC stock is going to go up in value, right? Otherwise, why would we buy it? But of course, at this point, if you're doing everything, and with a tax perspective in mind as well, you want to say, okay, well, where should I buy this stock? Because how am I going to be taxed differently? All right, should you buy it in your pre-tax accounts? Should you buy it in your after-tax or brokerage account? And those can be joint or individual. Or should you buy it in your Roth account? Your Roths are going to be your best, account moving forward. Well, let's see what happens if ABC stock actually goes up in value, and then later on we go to sell ABC stock, maybe to, we need the income to live on, to take out of our accounts. Maybe it ends up going to the kids, your beneficiaries. If you've passed it to them, how are you going to be taxed? How are they going to be taxed? Well, if it's in a pre-tax bucket, you're going to pay ordinary income tax on the entire thing, right? Our 7-bucket system, which goes anywhere from 10% all the way up to 37. There's 7 brackets that you're going to pay. It's the highest amount in our current tax code, the ordinary income taxes. And now if we look at the after tax or the tax-free buckets, the 2 buckets on the right, we've already deposited after tax monies into those, right? So the principal of what we invested is going to be money that we've already been taxed on. So we have to worry about how the gains are going to be taxed in those 2. Well, in the middle bucket, if we get to long-term capital gains, which is anything we've held over a year, it's going to be taxed at the 3-bucket system, which is 0, 15, and 20%. And the 20% doesn't kick in until you're like over 500,000 for married, filing jointly, and it's pretty high for individuals too. But these are preferred or preferential rates compared to the ordinary income brackets, right? And then, of course, the last bucket is the Roth, and all those gains are going to be tax-free as long as you've had that account open for 5 years. So again, your Roth's going to be your best account moving forward. And if you had one for a while, it's going to be it's just your best account. Certainly if it's been open for 5 years and you have gains. Okay, now on the flip side of that, let's say the company stock, obviously ABC stock can go down too, right? So let's say it goes down and you're going to lose money no matter what, right? But from a tax perspective, that middle bucket actually has some tax planning opportunities that you're not going to have in your traditional IRAs or your Roth IRAs, because the taxes have not been taken care of, already have been on those accounts. But in the after-tax account, you can do what's known as tax loss harvesting. You can use those losses to offset gains that you might have. The main thing here is just to remember that those There's moves that can be made in that middle bucket so that you're not paying taxes in a higher bracket than necessary when you have losses. It's not going to recoup your losses. It's not the intent. And maybe, for a lot of times it's more of a Band-Aid when what you need is like a tourniquet. But sometimes we can use tax loss harvesting to lower your lifetime tax liability. And of course, that's what we're trying to do, right?
We do have a question before we go on here. So the question was, what does that symbol NQINV stand for? That one right here where it says after tax.
Oh, non-qualified investments.
All right, thank you. And then one other question. Is there a reason why you can't use the Roth or like pre-tax to do any tax loss harvesting?
You don't, anything in an IRA is either, if it's a traditional IRA, it's pre-tax. So you can't do loss harvesting in there because you only pay tax on it when you take it out. And then anything in a Roth account is going to be tax-free. So you don't have to worry about doing tax loss harvesting there. So that's why another big reason why a Roth is so beneficial. But you can't do tax loss harvesting with it because everything in there is already after-tax money, and it's basically it's not even affected by the tax codes.
Okay, so that after-tax account is the only one that actually qualifies because it's the only one that actually you can realize those kind of tax loss harvesting. Okay, thank you.
With your actual investments, buying and selling and affecting gain harvesting or loss harvesting, that after-tax account is the only one that can affect that particular type of strategy.
All right, let's go ahead and move on.
Okay. All right, so now another question that I often get is, what happens, if I pass away? If I don't spend the money in my lifetime and it goes to the next generation, right? Our beneficiaries, what are those taxes going to look like? Well, in the pre-tax account, it's going to be fully taxable, like in your 401ks and your IRAs, except not at your rates. It's going to be taxable at whatever rates went into your beneficiaries, whatever their rates are. And unfortunately, and this really irks me, but the Secure Act that was passed in 2020 dramatically changed the opportunities that your beneficiaries have to minimize the tax impact on their inherited 401ks and IRAs. So you want to be sure to update your beneficiaries and look at your estate planning, because if you haven't done so since 2020, because you might want to make some changes, and maybe not. But what the biggest thing that it did was it did away with the stretch IRA, with an inherited account. And so now, just statistically, if the parents pass away in your mid to late 80s or whenever, and then that money, all that pre-tax money goes to your beneficiaries in their 50s and 60s, well, they're in their peak earning years, right? So then they get, you got to take that money out within 10 years, and they're going to get hit at ordinary tax rate. So it's going to be at a really high rate. So it basically what it is another tax on the middle class, which, it really upset me for my clients and upset me for my future and going to my kids. So anyway, it's something that you want to be very cognizant of, for legacy planning for sure. Now in the middle bucket too, we have what's called a step up in basis. And this is actually pretty cool. So, a lot of times people are like, well, what the heck does that mean, Tim? Well, if you bought ABC stock at $10 a share, and then when you pass away, it was worth $100 a share, and you hadn't sold it, it's going to step up into basis to whoever gets it. So in other words, it's just like they bought it for $100 per share. And if they sell it immediately at $100 per share, they're going to pay zero tax because of the step up in basis. So that's actually a pretty good thing. And hopefully they keep that. And then of course the Roth IRAs, the tax-free bucket on the right, for us and for our kids, our legacy, when we pass it on, there's no tax. So again, those are your best accounts. Now, just to clarify, you do still have to take that money out if it's inherited within a 10-year period, but since it's after tax money, it's not going to affect your kid's tax bill. All right. Now, something that gets missed all the time is, and it doesn't matter if you're like a do-it-yourself investor that you've been, or maybe you've been working with a financial professional for years that specializes in helping you grow your money, often, these types of advisors are going to do audits on portfolios from an investment or a risk perspective, and they should be. But often they're a lot of times what they're talking about is, hey, we got to increase the amount of risk, or we got to decrease the amount of risk that you're taking because you're getting close to retirement. And so you got to be very cognizant of the risk that you're taking, right? We all know that in our portfolios, we have some investments that are riskier than others, right? And so have you ever audited your portfolio from a tax perspective to make sure that your investments are held as efficiently as possible as it relates to our tax code and the risks that we're taking? Well, what do I mean by that? Well, let's assume that our less risky investments, right? The ones that we're not trying to hit home runs with, like our bonds or our treasuries, right? Where should you own those? Well, I would argue that you should own your bonds or your treasuries in your 401ks or your IRAs. Why? Because you're not trying to hit home runs here, right? You're going to have to pay ordinary income tax on those accounts. And again, that's the highest tax bill in our current code, right? So you want to keep your less risky investments here. Your steady eddies, the kind of like the baseline or the anchor of your portfolio. And then also another thing to consider is why would you want to own interest-paying investments like bonds and treasuries in a brokerage account when you're going to get taxed on that every single year? And then when you can hold them in a pre-tax account that you're going to be taxed on anyway when it comes out of that account, right? So basically, you're preventing being taxed twice. And then, of course, where do you want to hit home runs? Where do you want your growth investments to go? You want them going on the right-hand side in the Roth bucket, right? Because if you buy ABC stock at $10 and then it goes to 100, you don't have to pay tax on that. It's tax-free. So obviously, you want your growth stuff. So I would make a strong argument. And, again, over 10, 20, 30 years, this really adds up. But I would make the argument that the IRS has set up our tax code in such a way that our least risky investments, certainly the ones that are going to be paying interest every year, should be held in the pre-tax accounts like 401ks and IRAs. And your most risky investments should be held in your Roth IRAs. And now I know, probably there's a lot of you out there are probably sitting there wondering, hey, I wonder if that's what I got going on in my portfolio. Well, I can tell you, if you have an advisor and you're on a webinar like this, I would say it's probably unlikely. Anybody that I've ever has come in after a workshop, I have never found that. It's just like a hodgepodge of random things going on over the course of different accounts, or they're all invested exactly the same. Okay, second concept, to defer or not to defer. So I hear this all the time. People say, well, Tim, I am the person that you're talking about. I have most of my money sitting in a 401k or an IRA. And of course, that's what your industry has been telling me to do. And that's understandable, right? But now the question is, do I leave it in my IRA or do I start to take it out and do these things called Roth conversions? Well, let's go through an example and we're going to see if it makes sense for you or if it doesn't make sense. So let's say that we've got $100,000 in an IRA, and we leave it there, and that's just, there's still a tax bill associated with that. We're just going to defer it down the line until we have to start taking it out or we get to RMD age, right? Let's say our tax is 25%. And then also, let's say we have this over here that we've converted to a Roth and we've had to pay that tax bill, right? So you got $100,000 minus the tax bill of $25,000. So you're going to end up with $75,000 in your Roth because you converted it, and I also want to point out too, another thing that gets confused all the time, a Roth conversion is not the same as a Roth contribution. So a Roth contribution does have an income limit, but that's totally different than a conversion. A conversion has no income limits, no age limits. Everybody, you can convert any amount of your pre-tax accounts to a Roth at any time, but you don't want to do that typically because you're going to pay a huge tax bill. So what you want to do is fill up your bracket over time, but that's not the question, right? So let's look at this example here. We're going to say we're going to jump forward 10 years and say, was this a good idea or was it a bad idea? So both accounts double. We're going to say both accounts double. So you went from 100 grand to 200 grand. A couple slides forward here from here. Go ahead, one more. Yeah, and then you can see there. So your Roth went from 75 to 150. Your IRA went from 100 to 200. And but remember, you still have to pay off the IRS, right? Because it's a joint account. So when it comes to time to spend this money, you're still going to have that tax bill. And so then keep going. There we go. One more. There we go. Perfect. Right there. So as you can see, once they pay the 25% on the IRA part, when it comes time to use that money, if your tax is still 25%, and we're going to say it is here, obviously for this example, you're going to have 150,000 and 150,000, right? So it's a wash. So that goes back to the original question. Do we defer or do we not defer our tax bill? Well, here's how you need to think about this. If most of your money is sitting in an IRA or a 401k, you are making the bet that you think tax rates are going to go down because you've chosen not to pay the tax bill today. So if you're deferring till a later date on hoping for a lesser rate or that it stays the same, then that's what you're saying basically. And I know that most of you, if you're still working, then this probably is fine because you still have an income and you're still in a higher bracket. But if you're retired or close to it, you better start paying attention because this is really going to affect you. And let me ask you this now. Do you think it's likely that our tax rates, which are at historical lows and have been coming down for decades, right? Do you think they're going to go up or down in the future? Well, in my industry right now, we're literally calling what we have going on a tax sale. And almost everyone that I asked this question to has said, I think it's more than likely that our rates are going to go up from here rather than down. And I'd agree with that. Go back to that one of the beginning slides. We're talking about all the scary headlines, our national debt, everything that's happened the past, few years, everything's skyrocketed, right? Well, now we need to be able to pay some of that off. And where do you think they're going to go for that? And even if we do nothing, they're set to automatically revert back to 2017 rates at the beginning of 2026. So if you think that rates are going to go up and 80% of your money is in an IRA or, 60, 70, 50%, doesn't even matter. But then your thoughts are basically not aligned with your money. So basically you're the person at a casino that's going to, you think on the next roll that it's going to be, red, but you're putting all your money on black. And what's more is that this wheel is not like a normal wheel. Forget about the green piece, right? But this wheel is almost all red. And there's no 10-to-1 payout for taking the different odds. You're just going to be paying more to Uncle Sam. So, you definitely want to think about this, right? And again, I know that you probably haven't, but this is why you're here, right? Awareness. So you want to make sure that your portfolio lines up with your beliefs, and of course, while everyone's retirement situation is unique, if you have tax deferred assets, and you're getting close to retirement, there's probably a very good chance that you should be doing Roth conversions. If not now, probably when you do retire in what we call the gap years. The gap years are basically the years between your retirement and RMD age of 72. So let's say you retire at 65 and then you have 7 years until 72. Those are prime, really good years to do some really good tax planning and limit lifetime tax liability. Okay.
I know we had a couple of comments here, and I just wanted to address that. A question here about, do we know that the Roth will continue to be tax-free in the future?
I get that all the time, certainly from tax preparers too. And what I always like to tell people with that is, we always have to plan with what we know today, rather than roll the dice on what may or may not happen in the future. I would say, it's been around since the 90s. It's still here. I think it would be, who knows what will happen in today's political environment, but it would be, I think, political suicide if they all of a sudden just decided to tax Roths. But like I said, it's been working for a few decades now. We're going to continue on with that. But yeah, our tax code is written in pencil, right? But if they do that, then we'll have to come up with something else to minimize lifetime tax liability. And we will, because there's so much crazy stuff going on with the code. There's always ways to do it.
All right. I had a couple more questions come in. I'm going to hold one of them to the end here. A question did come in about getting a copy of this webinar. We are going to be posting that online, and also you'll get a copy to watch in your email. We'll send out a replay link. So anyway, let's go ahead and move on. This is an interesting one about the widows or widowers tax.
Yes. And this is another big one on awareness, right? People just don't think about this stuff. So, but the third concept here is the widows or widowers tax, right? And I know, some of you are married on this today, on this workshop, and some of you aren't, but I know that everybody knows people that are married, so just kind of bear with us here on this one. And again, it's just an awareness thing. So widow's tax, what do I mean by that? Well, if you've got a married couple, and I'm not going to go down to the weeds here, you can see on the screen, just go ahead and click through all those income sources here. So basically what you're doing is, if we've got a married couple here, and on the left, they're married filing jointly. And as you can see, different sources of income come from different places. You got your Social Security, your pension, your IRA. What they're shooting for in both of these is $96,000 a year in income. Well, when they're married filing jointly, their tax rate is going to be $7,185, 7.9%, right? So now, if you're, and also you need to think about, if you're married, what are the odds that you're going to pass away on the same day, right? Not good, almost zero, right? And the concern in this situation is not that they haven't saved enough money. They've done a really good job saving their money, accumulating their money over time, but now they get to retirement age, and you have to think about, again, what's going to affect my tax rate the most, where the money's coming from, right? Not what it is. And this is another good example. So they had not been working with a retirement specialist, a distribution advisor, or someone that looks at the tax code. And then what happens was they have to go into their advisor. Then they say, hey, look, I just lost the love of my life. I don't want to have to worry about the money. I just want to be able to maintain the lifestyle that I have. And the good news is, like I said, they had enough money, right? That's not the problem. But now we've had to rework on the right-hand side, when they're single, where that income comes from now, to get to that same $8,000 a month. And the bad news is, like I said, they didn't do any tax planning when they could have on that bill. So now, they're no longer married. So their tax brackets just got cut in half. And now they're have to file single. And now they're going to pay on that same income. And you can see there, it's flipped around. The portion coming from the IRA is higher, and the pension and the Social Security are both lower. But now, to get to that same amount of income, they have to pay $12,711, or 13.8%, when they used to pay 7.9% on the same rate. And for all you math whizzes out there, that's a 75% increase in their tax bill because their spouse died. And again, the odds of them both perishing on the same day are very low. So the odds of this is going to happen to a married couple are very high. And so if you don't do any tax planning, you want to take advantage of the beneficial treatment of being married, and if you're not, you need to start. Because of course, as you can see here, the tax code is much more advantageous while you're married. Okay, next, qualified charitable distributions. So one thing that happened is they changed and this is for charitably inclined, but it's just another example of a tool that is a great tool that everybody misses. I don't think I've I've ever talked with one person that they may have heard about this, but they didn't know how it worked. And they actually, when they changed the RMD age to 72 a couple of years ago, they actually left the QCD age at 70 and a half. So that's good. So basically what happens is, there's a few rules that you've got to follow. And this is a better tax saving than if you simply want to take money out of your IRA and write a check to a charity or your church or whatever, any nonprofit. But there's a few rules with these, you can contribute up to 100,000 each year. So pretty high. And then it's going to count towards your required minimum distribution for that year. So that's good. But you got to follow a few rules, like I said, and a lot of times people are like, well, we don't get a deduction for this. So why the heck would we want to do it? Well, you don't have to get a deduction because it doesn't even go on your tax return. So it's great. All right, so let's take a quick look at a quick example of how this works. Okay, so you have your option one, right? The cost of a qualified charitable distribution. If you take your RMD, we're just going to say your RMD is $5,000. You got to take your $5,000 out, you put it in your bank account, and then you give money to your charity, right? Or your church or whatever it is, your nonprofit. Well, the end result is, of course, the charity gets $5,000, but let's say your tax bill is 24%. Well, then you got to pay $1,200 in tax on that. So that actually cost you $6,200, right? Still has a tax cost. Now on the next slide, let's say that you do what's called a qualified charitable distribution, excuse me. But instead of just saying, hey, send me my $5,000 to my checking account, you're going to direct your custodian to give the money directly to the charity, and that's going to satisfy your RMD. And you obviously need to make sure that you report this to your tax preparer, because they need to know that, because people don't just send out forms for this. So you need to make them aware. But the charity is in the same position. They've got their $5,000 donation, but you're in a better position because you just saved yourself $1,200 because it's completely excluded from your tax return and you don't have to pay any tax on it, simply by knowing how to use the tax code rules to your advantage. So obviously, if you double that to $10,000 or $20,000 at a 24% tax rate, so that really adds up, right? And then if you multiply that by 5 or 10 years, big savings, right? All right, sequence of return risk. Now, this is a big awareness one too, but since everything kind of relates on our nest eggs, how we're going to be taxed and which accounts to use and so on and so forth, Social Security, how it all ties together, we always have to be cognizant of this. But sequence of return risk is what if the market drops significantly in the first few years of retirement? And that's just bad luck, right? But it's always a very real risk, and it certainly impacts the income options and tax situation relating to your nest egg. All right, so here on this chart here, we've got, this is a very good example of what sequence return risk is. Right here, it's showing two people, same amount of investment cash, same returns, same withdrawal amount, and the same inflation rate over a 30-year period. The only difference is investor A had 3 years of negative returns at the beginning of their retirement, and investor B had the same negative 3-year returns at the end of their retirement. So again, just luck, right? Basically, though, investor A started drawing money from their accounts, and before you know it, the amount that they were spending was way too much relative to the size of their investment accounts, because the market had just taken a big chunk out of their accounts the first few years. And so they run out of money around age 80, while investor B was just luckier and they were just fine because the big decline happened at the end of their retirement. So how do we protect against this very real risk scenario? Well, at my firm, we use what's called the guardrail investment strategy. And it's a dynamic withdrawal strategy that allows us to take out a little bit more than the 4% traditional rate. But the amount that we send you could change based on some rules that we follow and with the market. So basically, think of it like this: how you're driving your car down the road, and of course there's guardrails to keep you from going over the cliff, right? Well, we basically put guardrails on nest eggs, and hopefully your portfolio stays in the middle of the proverbial road. But if it's God forbid it should swerve and hit a rail, well, it's a lot better than your portfolio is a lot better getting dinged up from a rail than going over the cliff, right? Again, there's some rules and stuff that you have to follow with that, but that's what we use, obviously, for our clients. And I'm always happy to discuss with how that works. But the main point is you have to have a plan so that you're not shooting from the hip when the market takes a big dip. Sorry about that.
Well, it's funny because you mentioned this, and that's probably what people are thinking about right now. The market's down lately. What sort of risk do I have in taking out retirement funds? So this definitely, I feel like, would be on people's minds.
Yeah, any workshop that I do, I always talk about sequence of return risk because we specialize specifically with retirees and pre-retirees. And so it's always on the top of everybody's mind, right? And so we always focus on that at my firm. Okay, next slide, estate planning. Now, I'm just going to say this: estate planning is very important, certainly because of what the Secure Act did a couple of years ago, so do not avoid it. But it's pretty much its own presentation. So that's all I'm going to mention today, but don't skip out on it because you always want to keep everything out of probate, okay? Okay, now take a deep breath. That's a lot of information that I threw at you in a short amount of time. I just want to wrap it all up by saying that retirees often pay more in taxes than necessary. Our tax code is set up to poke holes in our retirement, and most people don't even know that it's happening because of our confusing system, our confusing code, right? That treats different income streams in retirement differently and has hidden taxes and penalties. There's a lot of landmines out there and a lot of mistakes that can be made. And of course, a lot of things can get overlooked from a tax perspective. And, if you're thinking about working with an advisor like, myself, a retirement income specialist, you might think, I don't know if they can impart enough change in my life to justify that relationship, and maybe you're right. But from what I can see, what I see every single day, I doubt it. Most people get to this point and they need assistance to do it all correctly. And at the end of the day, the tax code is just that, right? It's a tax code. It's not an opinion. It's not an option. It's not about looking, at one advisor or another and saying, this guy or this gal's mutual fund can beat this other guy's or gal's, or my portfolio is better than yours, or my daddy can beat your daddy up. It's about, this is basically just somebody looking at your overall situation and applying the tax code on top of it and making sure that you're working your way through the tax code as efficiently as possible, and that you're not tipping the IRS year after year after year. And also, the analogy that I really like to use is that it's important to remember that most people, if you ever try to ascend Mount Everest, most people actually hurt themselves on the way down the mountain, not the way up. Out of 4 people that die on the ascent of Mount Everest, 3 out of 4 actually die on the way down. And retirement planning can be very complex, and lots of hidden dangers and challenges that you're going to face. And so a lot of times that happens. People are coming down the mountain, and they're not doing everything in the most tax efficient way possible. So maybe they run out of money at 80 or 85 instead of what could have been 100. It could be a really big difference. It's a very confusing world of navigating our tax code. So, you always want to look for a retirement income specialist when you get to this stage in your life, because it's a different skill set. There's different solutions now. Obviously, investment management is very important too, but you just want to have somebody that's looking at that on top of, and then laying the tax code on top of that and saying, hey, we can do this, this, and this, right? Okay. So if no one has looked at your financial situation from a limiting lifetime tax liability, then you need to get that done, because there is no reason to pay the IRS 1 more cent than is absolutely necessary. And with all the disagreements in the world today, I think that's at least something we can all agree on, right? Why give Uncle Sam more money than they absolutely need? So now is not the time to be a drifter or a procrastinator. If you're close to retirement, you can make a plan to optimize your retirement future, but you definitely need to take action now. All right, thank you very much for coming. I hope you found this educational and informative. And do we have any more questions?
Yeah, we do have a couple questions. I want to go ahead and cover these. And then also, if we have more questions, go ahead and leave them in the comments. We'll try to get to as many of them as we can. Okay, the first question we have here is the step up in basis on non-qualified investments. Does that apply to spouses when someone passes?
It does. It always depends on the situation. So you want to make sure that the exact scenario, you let it known, but yes. And if I didn't say this part in the presentation because it's kind of morbid, but yeah, if you know someone, no one likes to think about their own mortality, but if you know someone's going to pass away within a year or two because of terminal illness, then there's some tax planning you can do to take advantage of the step up in basis. Again, I didn't hit that one because it's nobody likes to think about that, but yes, there is some tax planning that you can do.
All right, thank you so much. Here's another question. For the guardrail withdrawal strategy, how often is the investment strategy revisited?
For my firm personally, it's based off of tons of, if you want to look up a white paper, it's from William Klinger and Jonathan Guyton. They've done a ton of research, millions of models back from like 1900 or on to how it works. But basically what I do is, there's a certain mix of stuff that you do. And obviously everybody has a different risk profile, right? So it has to accommodate with their risk profile or match up with that. But then, yeah, I might adjust stuff quarterly. It doesn't have to be, once people get to retirement age, we're also focused on, we just use the guardrails to explain it. And it's a model that works. And it's, if this happens, we're going to do this. So we're not shooting from the hip, but basically it's we're also focused on return of money as opposed to just return on money, right? So we're thinking about both with this, and it makes a difference risk profile, but I would say no more than quarterly, unless some really crazy stuff happens. Like, in 2020, when, the market went down 35% in 3 weeks, we started to make some adjustments then. And then last fall, I made some adjustments. So I typically like to work with BlackRock and their advice. I have access to all all the research of all the firms. But we like to own a subsect basically of the greatest companies in the world, believing that, over time, the rising cost of retirement, they're going to keep up with the rising cost of retirement. And historically, it's worked.
All right. So a couple questions here, and these are related. So I'll just do the first one, which is more general, and then I have a more specific follow-up one. So having those 3 buckets that you talked about, is it advisable to have them all in say like the Roth, or should you have them in spread between all those 3 types? Can you talk a little bit about strategy on that?
Yeah, well, if you can get everything into a Roth, and that's going to be your best option, right? A lot of times you just can't do that because it depends. Like, sometimes with if people have a smaller pre-tax account, then you can eventually you can get all that money. And that's what we do. Like in the gap years that I mentioned, you can fill up a bracket each year, and you just got to run the numbers to see if it makes sense over time and how much to do each year. But if you can fill up a bracket each year, and you can eventually, my goal is always to get all the pre-tax money for my clients to a Roth by the time they're 72, if I can, and then if I can't, I want to get as much in there as I can. And sometimes even after they turn 72 and have to start taking RMDs, it's still beneficial to go ahead and do Roth conversions if their pre-tax accounts are high enough. So everybody's situation is a little different, but yeah, if you can get everything into a Roth account, that's going to be your best option. But it's always a function of tax rates, right? If you're paying a lower tax rate now than you will in the future, you don't want to do that. But it's probably going to be the opposite. So you want to get everything into a Roth because it's going to grow tax-free in the future. Does that make sense?
Yeah, that does help. Okay, here's the more specific question. So this question is about, you're going to be retiring, say, in the next decade, and you're doing the 401k and you're contributing the maximum, but the employer also has a Roth 401k. Does it make sense to switch contributions to the Roth, and what does that do to your income tax liability?
So again, it's always a function of what your tax rates are. So if you think right now your tax rate is going to be lower than in the future, then you want to go ahead and pay and do the Roth now. But if you think it's going to be higher in the future, then you want to keep it pre-tax now. It's just always a function of what your rates are, and a lot of times right now, if you're in a 32% or above bracket, then you might be better off taking the deduction now, unless you own a business and you're going to have income forever. You're going to have passive income. It just always depends on. It's always a function of your tax rate. So if you think rates are going to be lower now, then you want to, now than in the future, then you want to do Roth conversions. You want to put it in a Roth now. But if you think your rates are going to be, lower in the future, then you want to, do your pre-tax and keep your income, your income tax as low as possible right now. So if you're still working and you're in your peak earning years, then this is when you want to, kind of just say, okay, I want to keep my rate at 24% or under right now. And then when I retire, I can take over the course of, the next 6-7 years, depending on what your gap years are. And I can convert all of my pre-tax accounts to a Roth over, 6, 7, 8 years, whatever it might be. And then at a lower tax rate, and that's what we're looking at every day for clients, right? Is to see what makes sense.
Not a simple answer, definitely.
Yeah,
definitely individual.
Well, the biggest thing is, yes, everybody's situation is different, but the biggest thing to remember, it's always a function of taxes,
Yeah. And what makes sense with the math.
But keeping those, and another big thing that we do, and this is, where we make our money, is we pay attention to where those thresholds are. Because if I'm doing Roth conversions for somebody, I don't want to bump them into a bracket that's too high. It doesn't make sense for them. And I don't want to bump over the Medicare thresholds that's going to cause their, Medicare to go up a few $1,000s a year, because then it's just defeated the purpose, right? So every year we do a line by line item of everybody and say, this is where you're at. This is what we want to do this year. And we're going to keep a buffer under these thresholds so that we're not bumping you. Because if you go over those Medicare thresholds by $1, it's going to kick you up a few thousand a year, if you're married. So you definitely want to pay attention to all the thresholds. And that's a lot of times people they get the concepts maybe, but then they're like, man, I don't know. I don't want to mess with this. And I'm like, I don't want to mess with it either when I'm retired.
All right. Can you explain what a backdoor Roth is?
Yeah, a backdoor Roth is, obviously for somebody that has higher income in their earning years, but you also have to pay attention to the pro rata rule, which means if you have any money in an IRA account, you have to take that into account. It's a pain in the butt. It's another ridiculous formula. So if you have IRA money, you want to get that money into a 401k if you can, put it back into your company's retirement plan. But then you can contribute to, and this have it, income limits as well. You can contribute to a traditional IRA, but then you can do what's called a backdoor Roth if you're over the income limits of the IRA threshold, because anybody contribute to an IRA, right? It's just a matter of whether or not you can deduct it. So if you contribute to an IRA and you can't deduct it because your income's too high, you can go ahead and contribute that, and then you can convert it to a Roth and pay tax on it then. But again, if your income bracket, if you're in a higher bracket, you can't contribute to an IRA. And then if you are over the IRA or the Roth IRA contributions too.
All right.
But you got to be careful with those because of the pro rata rule.
Can you explain again what that pro rata rule is?
Well, basically, it's going to take a percent. If you have, let's say you have like 500,000 in a traditional IRA, and then you want to convert some money to a Roth. Well, you got to take that same percent out of your traditional and apply it. So you can only get a very small amount actually converted to a Roth. So it's generally not worth it, So, but you could take that 500,000 and put it in a retirement plan, a company retirement plan. Then anything in a company retirement plan doesn't count towards a pro rata rule. Mm-hmm. So really, that's the only time you want to do it. If you already have a traditional IRA with a lot of money in it, then I wouldn't even think about doing a backdoor Roth. But if you can put all that money and you can roll, if you have, let's say you bounced around with jobs, you got a 401k, you put it in an IRA, you get a new job that has a retirement plan, you can put that IRA money in the current retirement plan. In fact, most companies love that because that gives them more assets and more fees they can charge you, right? But be cognizant of the pro rata rule if you're thinking about a backdoor Roth.
All right. This is another great question. And I think this is the last one we'll be able to take. So if you're over age 75 and you're still working, so woohoo, for them, I hope it's an amazing career they're having. And is it too late to start a Roth account because it has to exist for 5 years before it becomes non-taxable?
No, that's obviously if you get to this age and you've never really done tax planning, then you've missed out on some opportunities, right? But there's always something that can be done, and certainly if you have legacy, think about a Roth for sure. But I would never say it's too late. It's always a function of your individual situation and what your goals are moving forward.
Yeah, and I would just say, with people living so long, they may have another 20, 25, maybe right. 30 years. And that could be of use in the future.
Absolutely.
Yeah. Well, I'm going to go ahead and end things out here. We want to thank Tim for all his time today and for sharing with us this education.
Yeah, thanks for coming out.
Thank you so much for attending. Once again, to our attendees, look for an email soon for a link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.